Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, macro developments, sector trends, and investment themes shaping the day. Today is Monday, May 11th, 2026. We're Elena and Marcus.
So looking at the tape today, on the surface, everything seems perfectly calibrated, right?
Right, yeah. The S&P 500 drifted higher by 19 basis points to close at 7,412.
And the NASDAQ 100 ticked up 29 basis points. So if you're just glancing at top-level equity index performance, it looks like a market comfortably digesting the data.
But if you look underneath that calm surface, we are tracking a highly bifurcated environment.
Exactly. Because you have this relentless, hyper-concentrated artificial intelligence narrative that is completely masking a severe mechanical vulnerability in the rates market.
And the fuse for that vulnerability, which is what we really need to unpack, is tied directly to structural refining capacity and the price of jet fuel.
Right. So that underlying reality is the mission for our briefing today. As you sit with your investment committee this week, you have to reconcile this disconnect.
Because you have seemingly bulletproof equity performance on one side, and on the other, you have institutional research desks officially capitulating on their rate cut timelines.
Yeah, they really are. We are seeing major macro models push expectations for the first Federal Reserve cut all the way back to December 2026.
With subsequent cuts delayed to March 2027. So we are no longer talking about a pause. We're talking about an entirely different cost of capital regime.
And we have to unpack the underlying causality there. Like, why the capitulation?
Well, it is not just cautious central banking. It is structurally embedded inflation. Top-tier economic models are now projecting core PCE to stay glued near 3% for the remainder of the calendar year.
And the mechanism driving this isn't a mystery, right? It's the direct pass-through of energy costs. But it's crucial to understand we aren't just talking about the raw supply of crude oil out of the ground.
No, we are looking at severe structural tightness in the global refining system.
Which is the physical bottleneck the market is just, completely ignoring.
Because even if crude production remains perfectly stable, the global capacity to crack that crude into middle distillates, specifically diesel and jet fuel, is running at maximum utilization.
Right, with essentially zero margin for error. When you have a constrained refining system, any minor disruption creates a massive spike in the products that actually power the global supply chain.
Exactly. And those transport and logistics costs get passed directly to the consumer, which effectively puts a hard floor under that core PCE data.
But unfortunately, the raw supply of crude is anything but stable right now.
Yeah, geopolitical tail risks are flashing red. Political headlines this morning indicated that the U.S.-Iran ceasefire agreement is currently on massive life support.
And that specific geopolitical friction is pushing WTI crude dangerously close to the $100 a barrel threshold. It's currently trading around $97.60.
So when you combine $100 crude with constrained refining capacity, you get an energy reality that ties the Fed's hands completely.
Right. So we have 10-year yields grinding higher toward 4.4% and oil nearing $100. Historically, that combination compresses equity multiples.
But the market isn't compressing.
No, it's not.
And the reason why is the singular gravitational pull of the AI trade. It is the only pillar holding the broader market up.
Yeah, you look at the semiconductor space today, and the SOXX ETF surged 2.39% to yet another all-time high. Capital is aggregating into a very specific thematic silo, completely ignoring the macro gravity.
Well, I am going to challenge the premise that this is a resilient market. Because if you look at the proprietary desk flows, the market breadth is just atrocious.
It is bad.
Right. Despite the NASDAQ 100 closing in the green today, 2/3 of the index members actually closed in the red.
Exactly. You have a handful of mega-cap tech names dragging the entire index higher while the majority of the market bleeds. That is extreme concentration, not resilience. I agree the breadth is historically poor, but you do have to respect the momentum of the hyperscaler capital. What we are seeing isn't necessarily an illusion of strength. It is a structural reallocation.
And right now, there is a major microshift happening within the AI trade itself. The institutional flow data shows aggressive outflows from broad tech ETFs like the QQQ and SMH.
And even heavy de-risking from leveraged tech vehicles. That capital isn't going to cash, though. It is rotating violently into memory-themed ETFs.
Like the DRAM ETF, which is up 30.7% over just the last week.
Right. It looks like the market has realized you can no longer just buy a broad semiconductor index and ride the wave.
Because you can build all the data centers you want, but if you don't have the physical DRAM to power the servers, the whole infrastructure build-out just stalls. Is this just a pure scarcity play?
It is entirely a scarcity play driven by hyperscaler capex. The hyperscalers are deploying billions into these massive AI clusters, and the physical bottleneck right now is memory capacity.
And when you combine that massive price-agnostic demand with potential supply shocks, specifically the looming threat of union strikes at a major Asian memory manufacturer, you get a severe supply-demand imbalance.
Exactly. The market is pricing in a scenario where memory simply cannot be sourced at any price.
Okay, but if the tech sector is in euphoria over memory scarcity, we really need to look at the other side of this bifurcated market.
Because while tech rips higher, the consumer discretionary sector is experiencing severe distress.
Yeah, consumer-facing sectors just logged their worst single day since 2022. They are lagging the broader market by a staggering 1,200 basis points over the last month alone.
And that ties directly back to the energy macro setup we discussed at the top of the briefing. When you have $97 WTI and tight refining margins, the price of gas at the pump spikes.
Which directly and immediately erodes discretionary spending. Add in rising consumer anxiety over inflation, and you have a heavily distressed sector.
Right. But what is truly fascinating is how this macroeconomic pain is being translated into systemic algorithmic flows.
You are talking about the commodity trading advisors, the CTAs.
Exactly. If we look at systemic positioning, CTAs are currently sitting at their 1-year minimum net length in energy and base metals.
So in plain terms, they're at their maximum extreme short position.
Right. At the same time, they are maintaining net long positions in agriculture and live cattle.
I want to highlight the vulnerability there, though.
Yeah.
Trend followers are max short energy right as WTI is pushing $100 a barrel on geopolitical risk.
Yeah, which means they are heavily offsides and vulnerable to a massive squeeze.
But the extreme positioning doesn't stop at commodities. It is even more pronounced in the global rates market, where trend followers are aggressively short global fixed income.
Right. Proprietary modeling estimates this short position at $140 million DV01.
We need to contextualize that DV01 figure for the committee because it really illustrates the sheer scale of the risk.
Right. So DV01 represents the dollar value of a single basis point move. That means for every 1 basis point move across the global fixed income curve, these trend-following funds are collectively gaining or losing $140 million.
Being at a $140 million DV01 short puts this positioning near the absolute lower decile of historical levels. It's an incredibly crowded trade, heavily betting on the higher for longer narrative.
But let's look at the systemic fragility here. If the consumer is fracturing, as the discretionary sector data clearly shows, shouldn't the fixed income market be catching a recessionary safety bid?
Right. Why are trend followers blindly pressing the short side in bonds if the underlying economy is cracking?
Because algorithmic models do not read consumer confidence surveys, and they do not care about retail earnings.
No, they read price momentum and moving averages. The momentum of sticky, energy-driven inflation data has forced these models into a massive short position.
But that creates a textbook asymmetrical vulnerability.
Yeah, which acts as a financial tripwire because these CTAs operate on algorithmic threshold models.
Right. If yields move even moderately lower, perhaps triggered by a single weak economic print or a sudden de-escalation in the Middle East, those models trigger blind, price-agnostic buying.
And institutional estimates suggest that even a minor downward move in yields would trigger $23 million DV01 of mechanical forced buying.
That kind of short covering could violently snap bond prices higher, crushing anyone who is late to the short trade.
And that underlying mechanical tension isn't isolated to the rates market. It is heavily present in equity volatility dynamics right now.
Oh, absolutely. We are currently operating in a highly unusual spot-up, vol-up environment.
Right. The VIX climbed 1.2 points today to 18.39, completely ignoring the fact that the underlying equity indices gained ground.
And typically, those two metrics are inversely correlated. If equities go up, the VIX goes down as fear leaves the market.
So when they move up simultaneously, it signals a profound underlying anxiety. We are seeing a feeding frenzy for upside exposure. It is pure call-chasing behavior.
The mechanics behind that are vital to understand. Portfolio managers are so terrified of underperforming this narrow AI-driven benchmark that they are aggressively buying upside call options.
Right, but when they buy those calls, the dealers on the other side of the trade are now short upside risk.
Exactly. To hedge that risk, dealers are forced to buy the underlying stock,
which creates a mechanical feedback loop where buying calls forces the spot price higher, which drives volatility higher at the same time.
And that perfectly explains the dramatic reversal we are seeing in dealer gamma positioning.
Yeah. Just 6 weeks ago, dealer gamma was at a near-record negative $7.24 billion.
Today, it has completely flipped to a massively positive $21.3 billion.
Which is the 8th highest reading ever recorded.
Right. And we need to explain how that positive gamma profile alters market behavior. When dealers are massively net long gamma, their hedging requirements naturally suppress market movement.
Right. If the market dips, their exposure requires them to buy the underlying index to stay delta neutral. If the market rallies, they are forced to sell.
They effectively become a synthetic shock absorber, pinning the market in a very tight trading range.
But that pinning effect breeds extreme market complacency. You can see it clearly in the options market pricing.
Yeah, single stock put call skew is currently sitting in the bottom 3% of the last 10 years.
Investors simply are not paying up for downside protection. They are assuming the dealer gamma floor will absorb any macroeconomic shocks.
And if you want to see a different angle on that exact same hunt for yield and disregard for risk, look at structured credit, specifically the collateralized loan obligation, or CLO, secondary market.
Right, we're seeing a broad-based rally there. Investment-grade spreads are tightening aggressively, with secondary Perrier coupons hitting the mid-100s, high 140s and 170s over the benchmark for AAA, AA, and A tranches, respectively.
But the dynamic in the CLO equity tranches, the riskiest unrated portion of the capital stack, is even more extreme.
Yeah, the available flow to these equity tranches is rapidly shrinking.
And the reason why is structural. CLO managers are utilizing captive funds, essentially vehicles they control, to buy up their own equity tranches.
Right. They do this to secure the broader AUM and management fees for the CLO itself.
Exactly. Because these captive funds are hoarding the paper, there is a severe lack of supply available on the secondary market.
This artificial scarcity is pushing super clean, long-duration paper to year-to-date tight spreads. We are seeing some equity tranches yielding over 20% cash on cash.
It is a desperate reach for yield that completely ignores the mounting default risks associated with a tapped-out consumer.
Well, I have to push back on this broad market complacency, particularly regarding the volatility data ahead of this week's macroeconomic calendar.
You mean the CPI and PPI prints hitting the tape in the coming days?
Exactly. Right now, the CPI option straddle is priced at just 52 basis points, or roughly $38.50 on the S&P 500.
Wow.
Right. Given the structural energy inflation, the refining constraints, and the geopolitical tail risk we mapped out, isn't the options market drastically underpricing the inflation tail risk?
It absolutely is. The options market is currently priced for perfection.
Yeah. It is assuming a smooth, disinflationary glide path that the physical commodity markets are explicitly telling us does not exist.
The bond market knows it, the commodities market knows it, but equity volatility is asleep at the wheel. This massive disconnect requires a very specific tactical response from asset managers.
Which brings us to portfolio strategy, because we are witnessing a major paradigm shift in corporate capital allocation, and the market's reward mechanism has completely flipped.
For the better part of the last decade, in a zero interest rate environment, investors heavily rewarded companies that prioritize dividends and stock buybacks.
Financial engineering was the dominant strategy.
But that era is over. With the cost of capital fundamentally higher, the market is now aggressively rewarding companies that prioritize CapEx and R&D.
Right, driven largely by the hyperscalers. If a company is reinvesting heavily in AI infrastructure, building tangible assets, and expanding capacity, they're granted a scarcity premium.
But if a company is just using cash to buy back stock to engineer a higher earnings per share, they're being actively punished by the market. You need actual return on invested capital to justify multiples today.
So how do you manage a portfolio through this? Institutional desks are strongly recommending a tactical barbell approach.
Because that spot-up, vol-up momentum driven by AI call chasing is so mechanically powerful. It is far too dangerous to blindly short this market. The momentum will simply run you over.
Right. Asset managers need to maintain their long exposures in tech and semiconductors to capture the upside, but they must aggressively hedge the tail risk.
And the specific trade implementations for that hedge are incredibly compelling right now.
Yeah, because of that extreme complacency and the dealer gamma pinning we discussed, longer-dated S&P 500 skew, specifically looking out to the 6-month and 1-year tenors, has relaxed to the 15th percentile on a 2-year look-back.
That means downside protection, the insurance on your portfolio, hasn't been this historically cheap in years.
And we are already seeing the institutional smart money move to capitalize on this mispricing.
Yeah, today's proprietary flow data flagged a trader purchasing 40,000 VIX July 75 calls for 0.31 live.
To put that in perspective, that is over $1 million in premium spent on a pure tail risk lottery ticket.
Right. That contract only pays out if the market completely breaks structure and volatility absolutely explodes.
That is a massive, specific bet from a sophisticated player who is actively protecting a large underlying long portfolio.
But aside from hedging the tech longs, there is another tactical play emerging in the beaten-down consumer sector.
Right. We noted earlier that consumer discretionary was lagging the market by 1,200 basis points. But prime brokerage data just registered the first actual buy skew in consumer discretionary in 2 months.
So you look at that setup and see a highly asymmetric tactical long opportunity as we head into earnings season.
Yeah, absolutely.
I struggle to see the bull case there. You just outlined a scenario where energy inflation is structurally embedded and the consumer is tapped out. Buying discretionary right now feels like catching a falling knife, not a tactical long.
Well, if we were looking at a 6-month hold, I would completely agree with you. It is a value trap fundamentally, but tactically.
Tactically what?
Institutional investors have already heavily degrossed their exposure to this sector. The bar is set so incredibly low for these upcoming earnings that any marginal positive news, a slightly less terrible forward guidance or a minor dip in wholesale gas prices could trigger a massive mechanical short covering rally in those specific retail names.
Okay, so you don't need the consumer to be strong. You just need the data to be slightly better than the absolute worst case scenario currently priced in.
Exactly. It is the classic setup. Heavily crowded short positions combined with rock bottom expectations.
All right, to synthesize all of this complex market architecture for your committee, we have 3 core takeaways from today's data. First, the surface level equity rally is technically fragile.
Right. It is acting as a mask over a deep divergence. You have hyper-concentrated, momentum-driven memory and AI capital flows existing directly alongside a severely distressed consumer discretionary sector.
Second, the macro reality is firmly setting in. Rate cuts are effectively delayed until late 2026 or early 2027.
And for portfolio construction, this necessitates a mandatory pivot. You have to favor companies prioritizing CapEx, R&D, and strong balance sheets over those relying on buyback engineering to artificially boost their EPS.
Third, you must respect the mechanics of the options market. With extreme positive dealer gamma pinning the market and unusual spot up, vol-up behavior indicating underlying anxiety, downside protection via longer-dated SPX skew is historically mispriced.
It is highly recommended to own that cheap downside insurance while maintaining your tactical upside exposure.
Which leaves us with a final provocative thought to consider before tomorrow's opening bell.
Right. We know this entire market stability currently rests on AI CapEx, masking the underlying consumer and macroeconomic weakness. So what happens to that incredibly complacent, highly leveraged VIX complex the exact moment a major hyperscaler signals even a minor temporary delay in their infrastructure spending?
That is the specific pin that could burst the entire gamma bubble, removing the mechanical floor out from under the market in an instant.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color and cross-asset analysis.